Hi, everybody. Thank you so much for joining us. I think Jason's going to share slides here soon, or Marty's going to share slides here. But we are so excited to have you this is our first tax policy update. We're going to do these quarterly and bring sort of the most important, hottest topics that we find are affecting our clients and the larger market. So with that, I'm going to jump right in. We today are going to be talking about tax policy, giving an update. Sarah is joining me, Sarah McGregor, and I will discuss the status of the bill, what's in it, what we're watching. And then we're going to have Jason come on and give you a trade policy update. We know that there's been a ton of fluctuations, especially over the recent weeks. And then we're going to wrap up with Marty, who's going to talk about credits and incentives, which are a huge part of this bill and some of the current negotiations going on Capitol Hill. So let's dive right into our tax policy overview. I just want to set the stage of where we are. In 2024, Republicans won control of the House, the Senate, and the White House. We call that a unified government. But they have really small margins, and that's really affecting how this bill is coming together. In the House of Representatives, right after the election, the tally was 220 to 215. Unfortunately, 3 members of Congress have passed since taking seat. And so right now the current margin is 220 to 212. That's a 3-vote margin. If you switch 3 votes from the majority to the minority, you can still pass a bill. But when you lose that 4th vote, it's 216 to 216. And in the House, there is no tiebreaker. Senate also has a 3-vote margin. You can lose 3 votes over there. Republicans won control of the Senate. And so in the Senate, there is a tiebreaker. So that 4th vote, again, that would tip you over. But if you lose 3, you'll be 50-50, assuming everybody's voting along party lines. And the vice president will come in and break the tie there. So just for perspective, so everybody knows, Tax Cuts and Jobs Act was passed using the same process we're about to talk about, reconciliation, in 2017. And at that time, 13 Republicans in the House voted against it because they disagreed with certain provisions inside of it. So we've got a diverse Republican conference. We've got some real fiscal conservatives who are very worried about our spending trajectory. And then on the other side, we've got some real moderates, some of which in the House are from blue states, right? We've got New York representatives in Republican districts, but a Democratic state overall, California, New Jersey, Connecticut. So we've got some of those items or issues at play here. One of the other backdrops that we're looking at here are national debt levels. And we've seen a significant increase in our rate of borrowing over the last 10 to 20 years. If you could, next slide, please, Marty. We have seen significant increases, and if you take a look, right, this is the last 40 years. From 84 to 24, we had a deficit in 84 of, that number represents 1.6 trillion, and now we're at 36 trillion. We're actually unable to borrow any additional funds right now. We had a cap placed on our ability to borrow on January 2nd. It was part of a deal struck in 2023. So the government's currently using extraordinary measures, moving money around in order to pay our bills. That ability is going to run out at the end of August to the end of September, somewhere in there. We don't have an exact date, right? Because we have to see how much revenue comes in, how much we spend. But as we get closer to what we call the X date, and that's the date on which the United States would default on its debt, it looks like it's sort of end of the fiscal year that we're targeting. And so that's another issue that's at play behind this bill. And again, some of the concern of those fiscal hawks, we've just seen these increases, and it's not attributable to one party. Every party has contributed to it. The ACA and the ARPA bill that Democrats passed have contributed. The IRA has contributed, and then Tax Cuts and Jobs Act has absolutely contributed too. So anyway, this is where we are. We're not on a great fiscal trajectory, and a lot of Republicans are hoping to get us back in line here. Next slide. Why is this an issue right now? Well, in 2017, Republicans passed, with only Republican votes, the largest tax bill that we had seen in 3 decades since the 1986 Act. And it changed a lot of the ways individuals and businesses operate or structure, investments. And right now, we're facing a cliff where many of those provisions, other than the corporate tax rate, are set to expire at the end of 2025. A few items changed. They didn't expire, but they changed their treatment in 2022, 2023. We've felt the impact of that here recently. But we have a lot of changes for pass-through entities and individuals that are going to expire at the end of this calendar year on December 31st if Congress doesn't act. So that's why we have this stimulus here today to act today on these items. Republicans with their unified government are pushing their agenda, but again, working within their diverse conference. We saw a deal pass the House late last month at the end of May. It was a little bit tumultuous in terms of getting it through. We had a fraction over here, the House Freedom Caucus, that was very concerned about federal spending levels. And then we had the SALT Caucus, which are some of those blue state Republicans who say that they are the majority makers. They're the people who put the Republicans in the majority, and they're very concerned about SALT, state and local income taxes, and the ability to deduct those. Next slide, please. Right now, we're using this reconciliation process. And this is a process that we've used, Democrats and Republicans, for the last 20 years, longer, but 20 years in a very partisan fashion. When there is a unified government, this is the way that many bills that deal with federal spending and federal revenues are passed. Reconciliation is something we use because in the Senate, it's not subject to the filibuster. There are some very specific rules that this bill must adhere to in order to have that privileged status in the Senate. But it does allow, it's sort of a fast track process. It's limited to these fiscal spending measures. And right now, we are in sort of different places with each chamber. We had a budget resolution. We're going to talk about that in a second. In the House and the Senate that passed. They passed the exact same budget resolution. Then the House went to their committees. They drafted their bills. The Budget Committee assembled it, and it was passed on the House floor. So we are right now in that fourth step, reconciliation bills considered. That is done in the House. In the Senate, we are still in committee action. So we still have that budget resolution. The House passed their bill. They sent it over to the Senate. The Senate is in the process of releasing their version of this text. In the end, at the end of the day, the Senate and the House are going to have different versions of this bill, both because the chambers have different priorities, but also because of the special rules in the Senate that they have to adhere to that the House does not. In the end, that fifth step there, that reconciliation step, that's what we're looking for. That is what the ultimate bill will look like. Once we have that, we'll know a little bit better, right? What's coming down the pike for our clients and our prospects. And after that, we will then work on we'll be loading you up with a whole bunch of information on how we can take advantage of these provisions that are beneficial and how we can mitigate the impact of any provisions that are not advantageous. I will say we have a whole host of tracking tax reform pieces that we'd love you to check out on our website, and we are sending out monthly emails in addition to timely emails when something really important happens that are sort of ad hoc. So please check your inbox to stay up to date, and you can always reach out to us if you have any questions. We are going to move on again, please, Marty, to the next slide. And I'm going to bring in Sarah, who is an expert in all things national tax. She is such a wonderful resource to talk a little bit about what's in the bill, right? What's in the bill from the House plan. And then when she's done, I'll talk a little bit about what we're expecting from the Senate thereafter. So Sarah, take it away.
Great, thank you. As part of the reconciliation process, back when Tax Cuts and Jobs Act went through and others, the first step is to get both houses to agree on what they're going to accomplish. This was the first time that the plans differed. House set up a plan, said we want we want $4.5 million worth of tax cuts. We have a floor of finding at least $1.5 trillion of spending cuts. If we can find 2 million, we'll get to the max 4.5 trillion of tax cuts. If not, we'll scale back the tax cuts to meet there, but that's our where we need to go. And when the scoring on their bill came through, they met those goals, which also explains why you see some things happening in the bill for limited periods of time and otherwise to meet this requirement. So the House could be a little more flexible as they go forward. The Senate needs to be more open when they set their rules because they can't really change them afterwards. So the Senate, in this case, set some very low bars. So only $4 billion for spending cuts, but we promised to find more. We're going to say we're not going to set a threshold for the cost of tax savings or tax cuts, but we'll work within some sort of framework. We promise we'll do a good job. So there was already a conflict between the House path towards reconciliation and the Senate's, and they're just hoping that they're going to be able to converge and get to a point with both bills where it meets everyone's, or at least most, or at least a majority of expectations, so it can be passed. Marty, next slide. So once the House got going, there was a whole lot of conversations and planning that started months and months in the fall and last summer. And so the House really hit the ground running. But there were, of course, some very important roadblocks, some barriers they needed to overcome, some negotiations to settle out. But once they got moving on those, the month of May, the House moved very quickly and dropped some initial language, dropped the final language, got a few changes made in the House Budget Committee, got it through. Trump met with some of those congressmen who were holding out and wanted more. They negotiated, they got the settlements, and actually on May 22nd, the House passed this. That was very fast. Usually we're seeing these things run out, and only a year-end deadline seems to get people to move and make choices. But let's go on and see what they accomplished in this bill. And now, just a reminder, this is just a bill coming out of the House. It does not have the Senate changes to it. It has not been accomplished and converged together so that both houses have voted on the same things, and it is not sent to the president's desk for signature. And more importantly, after that, it doesn't have Treasury implementation guidance to go with it. So, but with that in mind, let's back up. There were some important Tax Cuts and Jobs Act provisions that needed to be extended or refreshed. And this is really important for all businesses, and everybody's pretty much on board, would like to see these continue. Bonus depreciation at a 100% for property and equipment, R&E expenditures, research and experimentation. Marty's going to talk about that. Relaxing the limitation on business interest expense by allowing, again, an EBITDA add back, so allowing a depreciation, amortization, and depletion to be considered, and increasing the amount of the adjusted taxable income to allow more business interest expense to be deducted. And there were some new things added, like bonus depreciation for qualified production property. That is bonus depreciation on real property assets, which is something brand new. It's not been in there, but it's for new facilities designed to build and assemble products. Opportunity zones are going to be refreshed starting in 2027. States will be able to designate new zones. There's an emphasis on opportunity zones in rural areas and less urban areas, and more expensing for Section 179. Again, another way to accelerate deductions for assets. Marty, you want to move on to next? Right. There were a couple of revenue raisers in there. These were small. As a matter of fact, the employee retention credit is probably going to drop out because it doesn't meet one of the Senate's requirements to go into a revenue bill. And but that was only about a $6 billion effort. For pass-through entities, there is some significant changes to the provisions there. Again, these are sort of existing items, but they've been enhanced or expanded. The qualified business income deduction, which is currently 20% of most income of pass-through entities, partnerships, S corporations, That goes from 20% to 23%. That was an increase that surprised folks when it showed up. And the pass-through entity tax, the PTET, is also an important for pass-through entities to allow the entity itself to pay the tax and allow for a deduction as a result of the SALT cap. It was a way to work around that. There's some significant changes to this, and treating similar taxpayers in different industries differently, and that has raised some questions there. And then the excess business loss limitation, again, it's another way to slow down the ability of individuals to take losses from pass-through businesses on their individual returns. So that's expanded and enhanced. So from an international tax perspective, you've probably seen in the news about the new proposed Section 899 retaliatory taxes. It is a way to increase both withholding taxes and income taxes on individuals and businesses, foreign individuals and businesses who are investing in U.S. companies and assets and investments, if they are from countries that have what are referred to as unfavorable or unfair taxes. So digital services taxes and other kinds of taxes that the U.S. has issues with. It would raise the income taxes and withholding taxes on income earned by citizens and companies from those countries. If those unfavorable taxes are removed, then this additional tax under Section 899 would not apply. So it is a toggled on and off depending on what's happening. For other changes, very minor changes to the what was introduced with Tax Cuts and Jobs Act for GILTI, for FDII, and for the BEAT. They've lowered those phase out the deduction rates slightly to allow more income to be taxed under the GILTI and FDII regime, and BEAT raised the tax there for the largest corporations. And then there's what is called a super BEAT rate of 12.5 that would apply in under Section 899 situations. All right, Marty, let's move on to, all right. There were also a number of individual provisions. The good news for the tax rates that were implemented by the Tax Cuts and Jobs Act, TCJA, those brackets and rates stay in place. So the highest tax rate is still at 37%. The standard deduction is increased and actually get a little bit extra for the next 3 or 4 years. Same for the child tax credit. It's restored to a 2,000 level, but there's a little bit of a boost for the next couple of years to 2,500. AMT, alternative minimum tax, those higher exemption amounts are also continuing, which is all good news to see the same trends moving forward. Some new provisions that fulfill some of the promises that the president made while out on the campaign trail, the no tax on tips or overtime pay, and he wasn't able to, or the committees were not able to wipe out tax on Social Security, but they are including a $4,000 deduction for seniors. I do think this no tax on tips and no tax on overtime is going to be a real conundrum and complexity for businesses and their employees. And it's going to be something that's going to have to be worked out, because you can imagine in one business, if you have servers and others who are earning tips, but those that are on salary or on an hourly rate, they don't get to exclude any of their income until they reach 40 hours of compensation or whenever the overtime pay kicks in, versus the first dollar of tip gets disallowed. I think it's going to cause some definite issues for employers in these situations. SALT cap, very hard fought, lots of conversations about that, and increasing it from $10,000 to $40,000 with some sharp phase outs. And the other I'll mention here is the estate gift and the lifetime exemption for estate tax and gifts will increase to $15 million in 2026 and going forward, which is a slight increase from where it is right now under present law. So Casey, I think that kind of gives an overview of what's in the House bill. what's going to happen when the Senate gets a hold of it?
Man, yeah. All right. I would love to spend some time on the Senate. There's a lot going on. So the House usually, fiscal action starts in the House and it's been sent over to the Senate. And the Senate is a smaller body. And the members are elected every 6 years instead of every two. They obviously have a larger constituency. They have the whole state versus, a district, which has nominally a little under 1 million people, when we break the country out. So there are different dynamics here. Oh, and I do want to mention really quickly, nobody's missed a polling question yet. These are going to start with Jason. We have backloaded them. Oh, Marty, previous slide. So just on expectations for the Senate, they have, again, these rules. One of the rules is you can't make changes to Social Security. And so Sarah mentioned that there was a campaign promise that there would be no taxes on Social Security. That's not something you could do through reconciliation. That is one of the rules. And she mentioned the employee retention credit. Terminating it in January of 2024 is fine, but the Senate parliamentarian has given, and most of these items are not tax provisions, so we're not concerning ourselves too much, but there were also additional enforcement mechanisms, changes to the statute. Senate parliamentarian has said that violates rules in the Senate. Now, she hasn't given an explanation. She doesn't talk to the press or to anybody else. She just talks to senators. She is a nonpartisan arbiter of the rules. She's been there since 2012, and so the current parliamentarian is very well respected. And the House is in the process of, it's not something we talked about, but making little tweaks in the Rules Committee so that their bill will align with the Senate bill in terms of the violations of specific Senate rules. And the conjecture is that the reason those enforcement mechanisms are not allowed in the Senate is because that may affect Social Security income taxes, right? So that's what we're looking at. But here we are. We've got this House bill, and it was a really hard fought bill. We've got Andy Harris and Chip Roy, who are leaders in the House Freedom Caucus, really, really concerned about deficit reduction. And then, we've got those Lalota, Lawler, and we've got blue state Republicans who are really worried about this SALT cap. And we're sort of at odds here. The more moderate members don't want, and we're not talking a lot about Medicaid because it's not important for a tax perspective for many people on this, but it is important to the fate of this bill, who don't want to see massive changes to Medicaid, who don't want states to take over some of the cost of SNAP, which are food stamp benefits. And there are others who really want to see massive reductions in federal spending. And one of the interesting things is we talk about what we spend every year, say $7 trillion. Only $1.6 trillion of that is appropriated. Most of it is mandatory spending programs, right? Which is Social Security and Medicare. And then there's a portion that is the interest that we pay on servicing the debt, because we borrow every year that we run a deficit, we borrow money to cover that deficit. That's what makes up our national debt. So we have a really hard fought battle. It's a very fine needle to thread in the House. It's done. It went over to the Senate. Now House leaders, specifically Speaker Johnson, are lobbying the Senate very hard to keep almost everything as close to the House version as possible, because again, that was a really tumultuous deal. That vote count was 215 to 214 to 1. There were 2 Republicans who voted against it, who joined Democrats, right? That 212 is now 214. And there was 1 Republican who voted present, because if he had voted no, he would have tanked the bill. It would have been 215 to 215, and the bill would have failed. So you see there's a lot of pressure to get the bill through, but there are also some things that members hold really dear and are trying to make sure wind up in this bill. Again, whether it's deficit reduction or SALT changes or maintaining Medicaid, whatever the case may be. And Sarah's completely right. Deadlines drive action in Congress. That is always what it is. And we're going to talk a little bit about deadlines in a second. But one of the things, we mentioned that a lot of these things expire, but Republicans have tied the debt limit to this bill. And that is, it would be catastrophic for us not to increase our borrowing capacity before we defaulted on our debt. So that is something that is also driving pressure to get this done. So I will say, here we are in the Senate. We've got a few things at odds. the leader of the Senate, Thune, and the leader of the Senate Finance Committee, Crapo, Mike Crapo, John Thune, they are very powerful members who have been in Congress for a very long time, very well respected, both in their party and on the other side of the aisle. They are really fighting for permanence in those tax provisions that Sarah talked about, the business interest expense, bonus depreciation, and Section 174. President Trump doesn't necessarily support that. That's what's come out in the last week. And it's going to cost a lot of money, right? Which is going to upset the deficit hawks. We've got some Medicaid moderates. We've got those senators who are always sort of pulling people toward the center, who are very worried about, again, Medicaid and SNAP benefits. We have IRA moderates. Marty's going to go over IRA changes. There were significant changes, but we've got some senators and enough of them. Because remember, it only takes 4 to tank the bill in the Senate. So we've got enough of them who have come out and said, hey, we don't want all of these to phase out necessarily very quickly. Some of them we may not want to phase out at all. These are really important. We've made domestic investments in energy production, and we want to continue that. So there's a little bit of a fight about that. But again, this all costs money, and we're all in this backdrop of we have a ballooning national debt. Last year, we ran a deficit of $1.8 trillion. $1.1 trillion of our spending was just paying interest on our debt. And so that's what those deficit hawks are concerned about. So, right. So then we've got the deficit hawks. We've got a senator who's probably not going to vote yes, no matter what, a Republican senator, because the bill has a debt increase in it. And we've got another one who's really leaning hard toward no at the moment. So then, right, then we shrink our margin of who we can lose. So we're threading this needle in the Senate. And it has to go back through that same House gauntlet, which has different priorities. So we expect this Senate language to drop potentially Friday. Now, they don't always meet their deadlines because there's a lot more going on than anybody sees. It's all happening behind the curtain. We may see text late Thursday or Friday, but we may not see Senate Finance text until next week. We will get the text, we'll go through it, we'll bring you all of those insights, and then we'll see if it passes the Senate. And if it does pass the Senate, we'll see how it reconciles and what the reception is in the House. There may be some compromise here. We are not going to see committee markups in the Senate, especially not for Senate Finance. The majority leader Thune has left it up to each committee if they want to hold a markup. You can't hold a markup on Senate Finance because you've got one of those senators who's leaning hard no, and they only have a 1 vote margin in that committee. In addition, there's a special process in the Senate. It goes through things a little bit differently. And the Senate has something called vote-a-rama, where ultimately, if this comes to the Senate floor, Democrats will force members from the Republican Party on the record, which happens both ways, to make votes. They'll put them on the record for things that may not poll very well in their districts, because not every part of this bill polls very well. Some parts poll very high and some parts are polling very low. So it's going to be an interesting time. We are getting feedback from SALT Republicans saying, if you touch that provision, we're not going to vote for it. But in the Senate, there are no senators from blue states. The senators are from red or purple states. So that's not a priority for them. So we're working through all of this. I will end with, we just got a letter last night from 38 Republicans in the House telling the Senate, if you change and spend more money in your bill, you need to offset it dollar for dollar in terms of additional spending cuts or revenue generated, right, to the extent you provide more tax cuts. So we will see how this all plays out. It is it's going to be a very interesting ride. Ultimately, Republicans are still very likely to get this done. Their goal is to have this done by the end of July, because Senate is out and the House is out for recess in August. And we know that we could hit that debt limit at the end of August or sometime in September. If they do not pass a bill, we're going to have to find a different way to increase that debt limit and try to pass a bill before the end of the fiscal year, which is September 30th. If that does not work, there will be an effort to pass the bill. They'll have to sort of start the process over again because we're in a new fiscal year. There'll be an effort to pass the bill before these things expire at the end of the calendar year. One of those things that's very likely to succeed. That's just the reality of where we are, because it's a limited point in time where Republicans have control. I will say that there does seem to be, if all else fails, Democrats and Republicans are aligned on a number of these provisions, including business provisions and the extension of those individual rates, at least for people making under a certain threshold of income. So there are many, many options here, but that's why we're watching, because it will affect almost every taxpayer. But with that, I would love to turn it over to Jason, who is going to talk about trade policy and tariff updates. And we have had a doozy of a few weeks with this one. So I'm sure his insights are going to be very interesting.
Everybody, I'm Jason Hodell. I run the industrial group here, and like Casey said, manufacturing, supply chain, and tariffs has been by far the hottest topic confronting our clients these days. Having lots of calls almost daily on these with clients. We're going to start talking tariffs, and we're going to come at it from an angle of a tariff is another form of tax. It's a consumption tax on imported physical goods by definition. Okay, so it increases revenue. And like Casey said, that's the hot topic on the Hill right now is how are we going to balance the budget? How are we going to control the debt? And a lot of that is raising revenue. So that's one reason you want to have tariffs. The other reason that tariffs are supported by some is that there might be industries that need protection because of national defense concerns, or there are infant industries in America that we want to help grow, okay? And we want to create jobs. You know, you hear a lot of talk about that in the media. So let's answer an interesting question, which is, okay, we've launched all these tariffs. Have they started creating jobs? Has it made a change in the national picture here? And so this is pretty much the best data that exists, courtesy of the Reshoring Initiative. It's a great website. This graph, this is not one of those graphs that an economist will show, and the y-axis is fooling you, okay? Literally, the bottom of the graph is zero. Okay, so you can see back in 2010, we really didn't have much in terms of foreign direct investment or reshoring operations, creating jobs in America. It was about 10,000 jobs there. All right. You can see in 2019, we put an American flag there to mark, kind of the first launch of the Trump 1.0 tariffs, which were focused on China. Okay, we all know that. And those hit towards the end of the year in 2019, so wouldn't really have affected 2019 because it takes a long time to change your supply chain. Okay, so what you can see, the story here is that in those 5 years since the tariff 1.0 year, absolutely there has been an uptick in jobs created. Okay. And you can see the high water mark is 350,000 jobs in 2022. Whenever you look at where those jobs were coming from, over half were coming from China at that time. Okay. And then what's interesting, there has been a fall off, and we'll talk about that in a moment. But here's kind of some snap data here from just Q1 of 2025, and it's the table on the right, and it's showing which countries are sort of importing the most jobs back into America due to foreign direct investment and reshoring. And what's interesting is South Korea is number one. South Korea was not really a top three, job creator here. What's going on there? It raises some questions. Well, what's interesting is, very close ally in South Korea, obviously. The US military has a significant presence in South Korea, of course, okay? And there is a free trade agreement, between the countries. Couple things that are going on here. There is absolutely a negotiation going on behind the scenes. You might know that now in less than a month, the reprieve on the reciprocal tariff on South Korea, on paper, it's about to end, less than a month. It's a 26% reciprocal tariff that was announced by the administration. So there are negotiations going on. Couple things. There is no material tariff per se across the board in South Korea for American goods, but they do have a 10% VAT tax, which is charged at import. We don't have that mechanism. So, that's one thing that's on the table. But actually, the bigger deal that's on the table is the administration is asking South Korea to pay part of the military bill every single year. In this year, the bill is 1.2 billion, which is up about 8% from last year. But Trump has said that he wants that to be a $10 billion number payment from South Korea to America for defense. Okay, so big negotiation going on. So what does this mean? Well, as I look at that, a lot of South Korean companies, they're kind of hedging their bets there. They're saying, you know what? probably a global US tariff probably doesn't go away. And I need to have something in North America. I want to placate the American administration. And so you see this pretty big movement here in Q1 of 25 by South Korea, and then China's number two. Interestingly, Asia plus Europe is like 75% of the story. Okay. All right, so I hope that was interesting. Let's go to the next slide, Marty. So just to answer the question of why it's slowed down in the past couple of years, there was heavy electric vehicle manufacturing, electric vehicle battery manufacturing, think lithium-ion batteries, and then a lot of lithium imports and rare earths. Most of that was all kind of a China type operation coming to America, and absolutely that the majority of that's behind us, number one, but number two, you can see the headline there from Bloomberg, electric vehicle sales have slowed down. And so now you're seeing a little bit of a whipsaw there, which explains the slowdown. Okay, so now let's talk about tariffs a little bit more. So couple things. We're not going to get into the daily movements and the actual rates. That's very difficult to track, and it just seems to change every day. But let's talk about the U.S.-China negotiation. And there's headlines literally hitting our news wires today because that's going on in real time. This is incredibly important. I'll throw a couple facts at you that are just interesting. Right now, U.S. and China, their percent of the global economy, it's trending towards 50%. It's almost there. US is about 30% of the world economy. This is GDP that I'm talking about. And China is about 20%. That's the trend in a very short period of time. Half the economy are those two countries. If you have to go down the league table ranking of every country, how many countries do you need to go down to equal US and China? And this is using 23 data. The answer is you have to go 25 countries down to United Arab Emirates to get to the same magnitude in 2023 as US and China. So point of the story is this is an incredibly important negotiation. It's important that we work well together for the good of the global economy. Now, I'll save the punchline here in a second. We're going to talk about some critical assets that are part of that negotiation. So hold that thought. Very important was that the North American Free Trade Agreement, the United States, Mexico, Canada agreement, it survived, USMCA. There was a lot of worries that that free trade agreement would be scuttled. That did not happen, which has been great for the North American free trade situation. Thirdly, I think most folks watching the situation have kind of accepted that, you know, probably this 10% global tariff upon the rest of the world, it's currently live. And most operators have said, you know, in some form or fashion, that's probably staying. Okay. Whenever you look at the rest of the world and the taxes that American companies pay whenever we export, it is about 10%. In some cases, it's high single digits. Sometimes it gets into the teens. And that's looking at both the tariff and the VAT, because those two things work together. A lot of countries just have a VAT, and that's their mechanism for essentially charging an import tax. Okay. So the point is, a lot of the European nations have accelerated their moves to establish beachheads in America, manufacturing, distribution, supply chain. It's happening. And on the previous slide, you saw the table. Three of those countries were European nations. Okay, so that's in motion. And the last point, these very high tariffs, 50% on steel and aluminum now, and non-ferrous metal protectionism. We'll talk about that in a second. That's probably not changing anytime soon. And I'll talk about why that is in a moment. Okay. Let's dig into US and China because it is kind of fascinating. And I hope you learned something here. Go ahead, Marty. So this was taken a few weeks ago, changes every day, but these are the top 10 market cap companies on planet Earth. Okay. Well, most of them are in the US, 8 of the 10. Okay. And most of them are big tech. The names should not surprise you. Okay. If you look at the top, top 7 there, 6 are American, and those are all related to big tech. NVIDIA, of course, chips for GPUs, and then Apple, Microsoft, Amazon, Google, and Meta, Facebook. All right. Well, as you look at the table, what do those companies all have in common when you listen to their earnings reports and what they're investing in? And the answer is pretty obvious. Go ahead, Marty. They all are investing heavily in AI, the future of the world, whether it's the robotic piece, Gen AI, creative work, research, thought leadership, all these things now, AI is just changing the game, okay? Well, as you scan the list, look at number 10, okay? That is the chip company in Taiwan that's famous for making these types of chips, okay? But the story gets more interesting. Marty, let's go to the second slide on this topic. Whenever you look at AI chips that power everything that I just talked about for those 7 companies, okay, and you ask yourself, where are those chips being made today on planet Earth? And then who's making them, okay? The chart speaks for itself. This is pretty much the NVIDIA game for the most part. Obviously, those are made in Taiwan. And then AMD, Google, and Amazon, they're making their chips in Taiwan as well, okay? This is a graph of total revenues for AI GPU chips last year, okay? And then you have the US with a tiny little sliver, Intel in Texas. So the point of the story here is that if you're thinking about, where future value creation is expected on planet Earth, how it's being created in the tech world, all around AI, Taiwan actually holds the keys to the kingdom right now. Okay. There's been a great deal of, government incentives to bring chip manufacturing back, but those things happen over years. This is not a short-term change. Not a lot of people know that Taiwan is actually also known as the Republic of China. Okay, before the Communist Party took over, the former Republic leaders, they went and established the Republic of China on the island of Taiwan. This helps explain why Taiwan's kind of in the news every day. We all see the news reports about military actions around the island and what's going to happen here. All of this creates the situation, which is we're negotiating real time with China and trying to figure this out so everybody can work together productively. All right. So I hope you liked some of that inside baseball. So first polling question of today, it's a little bit of a layup. You can go ahead and launch it. Basically, what can we likely expect in the future around tariffs? Hey, onshoring pressures are going to continue. It's not just the tariffs, but there's uncertainty. Think port uncertainty. There's incentives from the federal government. Okay. Tariffs are absolutely a negotiating tactic. We've talked about that already, whether it's military defense or chips or access to chips or technologies. And then lastly, retaliatory tariffs and escalation among the countries. And of course, the answer here is all of the above. Okay. Go ahead to the next slide. All right. Here is a tough polling question. This sets up the next subject because we're going to transition into trade policy and incentives. So 5 years ago was in a very important act that was signed. It was a bipartisan act, okay? And that was the Jobs and Infrastructure Act. And the headline number was 1.2 trillion in incentives. So here we are in 2025. How much of that pot of funding still remains? It's still up for grabs. You can see the 4 choices there. We'll leave it open for about 15, 20 more seconds, and then we're going to show the results because it's always interesting to see the Venn diagram. All right. Pretty spread. The answer is 300 billion. So 19% of you got that right. You guys are smart. So of the original 1.2 trillion, about a fourth is still out there. Go ahead, Marty. So let's talk about the Jobs and Infrastructure Act. Casey kind of just set this up with the real numbers, right? From the last year's budget and just how much discretionary spending is really out there. 1.2 trillion is a big number, okay? And 300 billion of it still being up for grabs. That's still a big number in the world of government incentives and spending. I highlighted two of them of the 12 programs. I highlighted those two for a reason. Grid resiliency is absolutely still granting a great deal of projects, mostly to utilities and whatnot. But the Inflation Reduction Act also doubled down on this theme. And you saw a lot of investment in energy, next generation energy, solar, of course. And like Casey said, that's one of the earmarks that's been highlighted, that's being debated, because a lot of people feel very strongly about energy dependency and the cleanliness of that energy. Okay. And then the other one that I highlighted on the right are all these programs around ports and waterways. That's an issue because as people are onshoring, back to, my second slide there that showed you the countries that are onshoring now, as they onshore, one of the key things on that checklist is, well, I need to be close to a port. Okay. And then secondly, I need to be close to rail and then maybe highways, but that's kind of the trifecta. Okay. Right now, Cherry Bekaert, we are doing a lot of work helping folks that are choosing to onshore and nearshore do all the math around the credits and incentives at the federal and the state and the county and the city level. And a lot of them are negotiated. You can't do a Google search and find out what to negotiate. These are negotiated behind closed doors. But part of that are port incentives. Okay, they can be very lucrative and help pay for your project. So a couple things there, but at very high level, these are programs to rebuild the infrastructure of the United States. And one of the critical items, go ahead, Marty, as you compete to be awarded a piece of the 300 billion in revenue that's out there, well, the government's asking for a BABA certification. It's essentially made in America, and this was established in the bipartisan bill of 2020. That is why I made the comment earlier that, kind of this steel, aluminum, non-ferrous metals protectionism. This was a bipartisan effort. Probably is going to stay in some form or fashion for the time being. But if you want to compete for the 300 billion in projects that are out there, Made in America or BABA certification, for many of the projects, it's mandatory, period, full stop. Okay. There's two categories here. You're either fully made in America 100%, or you have to meet a 65% threshold. Okay. That's number one. Number two, in some projects, you get front of the line privileges. You just get ahead of everybody that's not BABA. And then thirdly, whenever you're a domestic supplier, in some programs at the state level, you are given a written preference. Okay. And then for federal supply chains, you have to be BABA compliant now. So this is a real thing. So what do we do at Cherry Bekaert to help our clients? Go ahead, Marty. So a lot of folks in the middle market, this, you can imagine, requires a lot of paperwork around your supply chain, especially if you have a multi-tiered supply chain. Think of final manufactured good with lots of subcomponents. The subcomponents are then procured from sub-suppliers and so on and so forth. So proving that, the final good is made in America and comes from made in America raw materials to a certain percentage, it's a lot of paperwork and math. And so we help people get that organized. We help them query their supply chain. We put everything in writing, of course, like an attestation, and we help people submit all of this and also submit waivers. And this is a hot topic right now, and we're helping lots of clients do this as they onshore. All right. So let's go ahead to the final polling question for myself. You can check all that apply. It's multiple choice. Basically, if you or one of your clients needs help with anything I just covered on the tariff piece, free trade zones are an amazing tool to give you more flexibility in cash flow and deal with this issue. Or BABA, just answer here and we'll be in touch. All right.
Yeah,
Thanks, everybody.
Thank you so much, Jason. As we leave the polling question up for another second, let's transition over to Marty, who's going to talk about tax credits and incentives, and specifically some of these credits that are in the IRA bill and their potential future, how to take advantage of them, other opportunities to save on tax. So Please take it away, Marty.
Absolutely. Thank you, Casey and Jason. So we only have about 10 minutes left, and I have a number of slides, but I'm going to be able to get this in the 10 minutes. And first and foremost, by skipping this one and getting to some of this, what we have here, which is where Cherry Bekaert is focused on credits and incentives. And what I'm going to talk about in a little more detail right now is just on where we are from an R&D perspective and what was in the bill. And why don't we start there right now? As you know or don't know, since 2022, under TCJA, taxpayers have been required to capitalize and amortize their research and experimentation expenses, both foreign and domestic, over respectively, I guess, 15 or 5 years, which has been onerous, I would say, for a lot of the companies. Many that we speak to about R&D had always been a very positive conversation about like claiming a credit. And it became a conversation about mandatorily identifying what had to be capitalized and amortized while also doing a credit kind of on the side to offset some of that. So that kind of changed the nature of what we were doing. What is proposed right now, and I expect should something come through the Senate and something ultimately get passed, this will probably survive, is a return to current year expensing of research and experimentation expenses for a period of time, not made permanent. But what we see in the House bill is from 2025 through 2029, the ability to immediately deduct your research and experimentation expenses, but not retroactive back to 2022. So you'll continue to amortize what was there and I guess capitalized previously over the time period going forward. And it will be a return to basically defaulting toward current year expensing, but also options and elections that you can, as there was before, to capitalize and amortize your research experimentation, should you like, and you're looking to preserve some attributes over time. So that's going to be a huge deal for any company that either performs any software development activities, because that was deemed to be sort of de facto R&D, and also for just any companies that do R&D, both foreign and domestic. What we'll see most likely is, because the method by which you treat these expenses is an accounting method, we'll probably see some default disclosure allowed to be provided without filing a Form 3115 if done on a currently filed return in 25 going forward, to make that change. Most good people are going to want to make that change as we go forward. So I think that's the biggest deal, I think, of what I have to talk about here. We'll talk about more as well, because it's probably going to affect like our practice the most, and how many companies, how they're going to overall take a look at what their overall taxable income is, their NOLs are. This will have a profound effect. And just as well, I'll talk a little bit about this too. In 2025, it's not part of the law here, but there is, beginning in 25, combined with this, a new disclosure requirement on the Form 6765 when you do these research credit analyses. So I think 2025 is just a banner year for both taxpayers and also potentially providers, by really saying, hey, now's the time to take a look at what you have going on from an R&D perspective. What's your potential for credits, and what are your processes like when you want to claim these credits? You're going to have to disclose a lot of what you identify as projects, and the cost by project, and what you're trying to do from an R&D perspective right on the return. So it's going to be a big deal in 2025. So we continue to publish things almost weekly as the law changes, but also as we move toward taxpayers starting to have to file and identify what their costs are for 2025. This here, by the way, on this slide is just what we see from a capitalization summary perspective. We see the costs that go into the research credit of the wages, supplies, the cloud costs, and the contract research. But below this is all the areas we were looking to identify additional adjacent expenses that would have to no longer be expenses, but rather be capitalized and amortized. Change quite a bit of the work that we would have to do. One more point. Only for domestic. So when we're talking about what has to continue to be capitalized, we are only talking about what can be currently deducted. We're only talking about domestic expenses. Foreign expenses under the rules as provided are still going to be required to be capitalized and amortized over 15 years. So this is again in line with the concept of onshoring clearly a push to do more of the work onshore. It will be tough for software developers where a lot of that work is done offshore. But again, this is the price of, I think, lower rates. And but nevertheless, it will still be much better than the regime under which we operate now for taxpayers as they identify what needs to be currently deducted versus capitalized. I think you're going to see a lot of companies coming out of the woodwork that hadn't claimed R&D credits that suddenly decided they have R&D because they can perhaps for a period of time feel have no fear of disclosing that for fear of like not being required to capitalize. I expect that because I saw some companies kind of shy away from looking at certain activities as R&D. Nevertheless, software development always was R&D, and it was sort of de facto treated that way. Okay. I'm going to skip through some things here because we have about 5 minutes left. I talked about the disclosure requirements on the Form 6765. Again, not part of the legislation. It's already part of what is being expected on your returns. But this is probably the most other important thing, I guess, in my group and potentially like my life at the moment right now. The Inflation Reduction Act, as Jason was alluding to, it was just a massively big deal for companies back in 22. It came into effect in 2023. One of the major changes, well, they were twofold, really. One was the ability for not-for-profits to start to take advantage of these credits through something called direct pay, where they could actually get a direct check from the government. The other was the ability to transfer credits to another taxpayer directly. Previously, companies would have to be involved in what's known as like a tax equity transaction, where you get into a partnership and some of the attributes early on would flip to some of the owners, the credits, and then later you get an income distribution. Those were complex and kind of dominated by larger players. What happened in the Inflation Reduction Act was almost a democratization of the ability to like who is financing these credits. And so the ability to transfer from one, shall we say, developer without a tax liability to another by virtue of selling it was just a large, really big deal for a lot of C Corps out there that could just look to buy credits. What we're seeing under the new House bill is quite a restriction on overall transferability, which is going to be basically, you have advanced manufacturing production credit, which 45X, clean fuel transferability ends after 2027. We're going to see transferability end for a lot of things very soon. But I'm going to sort of like almost not say a date because what's coming out right now with the Senate, I think will be a change as well. But we also see with respect to some of the tech neutral credits, which is the wind and solar under what we see here as a 48E, there's going to be a new requirement, at least as proposed, that in order to qualify for this, projects are going to have to begin construction within 60 days of the passage of this act. So that now I'm having conversations with companies that want to begin construction now or begin construction soon or basically like incur 5% of the spend right now so they can claim that they began construction, but they'll also have to put it in, basically finish it and place it into service before 12/31/28 across the board. These were going until 2032, shall we say, under Inflation Reduction Act. We are seeing the year go back from 2032 to 2028 for some, to 2027 for transferability, to immediate for the commercial clean vehicles, clean hydrogen credit, new energy efficient home credit, for like basically all disappearing after 2025. This is still up for debate, and it's going to be a lot of debate going on because a lot of these projects benefit red states, and a lot of senators want to continue this. So we may see certain credits get extended, certain credits perhaps be like pulled back. I don't know exactly how it's going to work out, but we certainly have it under advisement for you and under analysis for us to see what's going on. Last point here is what we have from a real estate perspective. I'm just going to talk about bonus depreciation mostly. When we do cost segregation studies, one of the big benefits had been to allocate a certain portion of the property into a bonus depreciation category. That actually made the return on investment for a cost segregation study significantly increase compared to what it is even today, because bonuses go down to 40. I'm going to ask this tax polling question now as I continue to talk. Would you be open to having Cherry Bekaert perform a complimentary assessment I would say of your expected taxable income for 25, along with what credit documentation you have in place, considering the potential adjustments to R&D and bonus depreciation, and potentially what may be available to you from an IRA. Yes, maybe in the future, no. Last point that I will get to here, and then we will conclude because we're out of time. Qualified production property. Think of this as a manufacturing facility and getting basically 100% bonus on that. This is something to encourage the construction of manufacturing facilities in the US. I thought, and maybe Casey thought, or there had been some talk that maybe the old Section 199 regime may come back. I think this is sort of like trying to deal with the same thing, an incentive to do manufacturing in the US. So we're going to keep our eye on this too, going forward. And I will go to the polling question, and there we are. Casey, we're done.
Yeah, thank you so much for joining us. A lot of this is still being written, and we will certainly come out with additional content as we have answers and takeaways. So please look for that. But this concludes our webinar for today. Thank you so much again for joining us. If you have any questions, reach out anytime. Our emails will be in the email that you receive in response, in addition to a short survey, which will appear when you leave the session. So thank you again, and we look forward to hopefully seeing you soon.